And now introducing our next panel, which is Sustaining the Pace of Financial Inclusion, Fintech, CBDC or else. I'd like to invite Mr. G. Padmanabhan, who will be the moderator for this panel, Mr. Navin Surya, who is the Chairman, Non-Executive Fintech Convergence Council. He's an investor, founder, mentor, advisor, and Fintech industry thought leader. A huge round of applause. Mr. Rishi Gupta, who is the Managing Director and Chief Executive Officer of Fino Payments Bank. He's currently associated with one of the premier industry associations in the country, ASSOCHAM, and as the co-chairman of the National Council on Banking and Financial Services. A huge round of applause to Mr. Rishi Gupta. And next, I'd like to invite Mr. Suresh Sethi, who has over 3 decades of diversified global experience in the financial services industry and works extensively in the financial inclusion space, leveraging fintech and digital-led innovations to make a difference. He is currently the Managing Director and CEO of Protean e-Government Technologies Limited. A huge round of applause to Mr. Suresh Sethi. Over to you, sir.
Can be heard? Yeah. Okay. Thank you very much. We move away from the glamorous world of treasury, globalization, to Atmanirbhar and financial inclusion. So it's a completely change, but let's try to make it interesting. I think the financial inclusion part has been here for quite some time. I'm not trying to sort of reinvent or redefine what is financial inclusion. Everybody knows about providing affordable services, and any growth to be sustaining will have to be inclusive. All this we are aware of. I think what's important is the Reserve Bank of India got into the picture in a big way. Initially, as usual, the central banks world over, we also got it wrong. I still refer to we when we refer to Reserve Bank. We got it wrong in the sense that the Reserve Bank initially thought that the financial inclusion can be driven only by banks, and then the bank, it had to come as 4 products all coupled together, what we call the deposit, the payments, the credit and insurance. I think there was only one interesting thought within Reserve Bank of India at that point of time, which was articulated by the then Deputy Governor, late Subir Gokran. And Subir, in one of his speeches, said that the problem with the financial inclusion in this country is that we think we know what the poor people want, but we are not able to really understand or decide or understand what exactly they want and make this available to them. That's number one. And secondly, the fintechs or the non-banks came and asked this question: why banks? Why banks alone, and why these products must be given coupled? Why don't we decouple the whole thing and then probably couple it or bring it together at some level? So these were the interesting developments that happened when we talk about financial inclusion. I think in 2020, Reserve Bank of India came out with what they called a national strategy on financial inclusion for 5 years. Again, I think probably they got the timing wrong, not entirely due to their fault, because the next 3 years simply went away in COVID. And again, probably the priorities will have to be rethought about. Now, having said that, I think we need to admit that considerable progress has happened. If you look at these 4 products on its own, deposit, payments, credit and insurance, I think in deposit and payments, considerable progress has happened. Whether we like it or not, as far as the payments, particularly the retail payments are concerned, I think India is the toast of the world, particularly as far as the UPI is concerned, which incidentally clocked 7 billion plus last month. So that's something which people are trying to mimic around the world. As far as deposit is concerned, because of the government initiative, a number of Jan Dhan accounts or no-frills account got opened. In fact, that was a challenge for the new set of banks, the payment banks and the small finance banks which came in. But however, I think number of accounts have got opened, which is again a fact. But I think as far as the insurance and credit are concerned, there is considerable lag Uh, and I think one thing that we need to understand about the way Reserve Bank has, or the government has driven the financial inclusion, particularly in payments, is I think the very structure itself was something which the world has not seen before. I think people like Navin were in the initial thought process where the whole model was being driven. I think speaking of UPI, CGAP CEO Greta Thunberg, and I quote, that captures everything. India has been at the forefront of fintech revolution with a unique public-private model. And then comes the important observation. Not only has India been a world leader in building digital ID, a world-class payment system, but it has done this with an eye to inclusion and competitive landscape rather than the winner takes all model, which is unique as far as this country or the world is concerned. So that is where I think we differed from the rest of the world. The progress as monitored by the Reserve Bank of India Financial Inclusion Index has been commendable. I think the numbers changed by 2.5 from to 56.4 last year, March 22, when the data is available. The Reserve Bank has also flagged many of the issues which needed to be taken care of, which is on the universal access, bouquet of financial services, livelihood, customer service, all these kind of things, customer education. But the question that we are trying to discuss here and over the next, let's say 35, 40 minutes, is trying to understand financial inclusion, to my mind, is at crossroads. We have achieved certain basic things. Now to proceed, there are certain important things that we need to get right. And there, particularly when it comes to the role of fintechs and non-banks, I think the promoters of these entities are today in a confused state of mind because of the way in which the regulations are getting driven and articulated. So where do we stand? What do we need to do right to get this act right? Because financial inclusion is quite critical. And probably what needs to be really thought through instead of allowing certain products to happen. For instance, during the course of discussion, we will try to articulate the fact that one of the main areas, the credit, was in some way being taken care of by the non-banks and fintechs, and then the recent regulatory moves by the Reserve Bank of India cannibalize that to a large extent. So these are the issues which the industry is grappling with. The speakers have been, the panelists have been introduced to you. They need no special introduction, but I want to make a special mention of a recent talk which Suresh gave at the Singapore Fintech Festival. I was fascinated by the topic you spoke on, which says banking on trust, how the ubiquitous postman became a catalyst for financial transformation. Did I get that right? I think very interesting talk that Suresh gave. So how we propose to structure this panel is maybe a couple of minutes, given Biju has already, before we started, Biju has given me an end time. So, and he says we are running late, so I tried telling him I am not responsible for that, but he says, however, cut it out. So instead of 3 minutes, let's say a couple of minutes, your initial thoughts, then we will go to the specific issues. Maybe I'll start with Suresh.
Thank you, Mr. Padmanabhan. No, sir, I agree with you absolutely, the points you called out. And since we are talking about sustainable financial inclusion, I think certain things which go at the heart of the matter is the fact that inclusivity is critical, but affordability and access. And these are two factors which become very relevant. And India's story, as we've seen, I think Aadhaar, the national ID itself, has been a foundational moment. So once people had a digital ID and that enabled access. Coming forward from there, you are talking about ID becoming the foundation, but equally important was the fact which includes literacy. So when people were able to open bank accounts, and we've seen, and it's documented again, that India's inclusion journey, because of foundational factors like the ID, took 7 years, what otherwise would have taken 46 years. So the sort of account penetration that we got, that was phenomenal. But what became very important, and again, carrying forward the discussion we had around India Post, was the fact that just telling the people open a savings account doesn't solve. Because it is not the count of accounts that have got opened, it is the accessibility and the ability to use them. And there comes literacy, and it is equally important that the sort of product design you take on the ground, and that is where fintechs and the extensions that you get alongside the banks become very important, which have helped the people realize how they can use this particular facility. Accessibility has another factor to it, looking at the geographic width and breadth of the country, and the fact that in rural India, how do you get access? The physical distances need to be covered, and technology plays a big role. And I think India has been unique again in setting a very strong assisted model in play. Everybody does not need to self-serve, and I think those models have become very, very relevant in our context to say that the last person on the ground does not get left out. And affordability definitely, because some of the technology transformations, especially when we look at the fact that there is a lot of focus on creating digital public rails and putting an open architecture around them so that everybody can play on these same rails and provide solutions and services at the last mile. So I think these are the three factors I would like to call out, which have gone a big way in reaching where we are today in terms of sustainable inclusion at the last mile.
Thank you. We'll take this forward. Now, I think, can I ask Rishi to give his thoughts? I must say that Rishi resembles the Karna in Mahabharata. So far, they have been giving as Fino. I think they are yet to become, in terms of making money, but they have been doing enormous service as far as the financial inclusion is concerned. Earlier as business correspondent and now as a payment bank. I think, Rishi, your initial thoughts.
Thank you, sir, and good afternoon to everyone. So, I have been talking about financial inclusion for the last 16 years, and the fact that Fino was created 16 years back, and when RBI came out with this outsourcing guidelines on business correspondence. So, a lot of things have evolved in the last 15, 16 years. I think the fact that the India stack came in, the technology actually helped. The initial 5-10 years, we had a big issue because financial inclusion and everything was tagged with banks as a public sector banks, more from a give perspective as a social initiative. And financial inclusion could not actually become a business model, and a lot of people actually thought about the fact that financial inclusion is more of a service to the poor people, and it's not a business model. I think in the last 5 to 7 years, a lot of transformation on the thought process across the industry has happened. I think that's one of the big game changer from my point of view when commercial institutions and we talk about fintechs now getting into financial inclusion, because from a social initiative, it has become a business initiative. I think that is one big change which has happened. Fortunately for us in today's world, we are living in a technology which is available, network which is available. Way back, 10 years back, 2G networks, technology being not available, power was a big issue. A lot of those hindrances have been taken care of. I would say on the access part, which my friend Suresh talked about, we had a big challenge about it a few years back. But now with the availability of business correspondents, merchant network, more than 3 million merchants are connected with various banks, whether it's a payments bank or a universal bank or an SFB. A lot of the access issues have been solved. So opening an account is not a problem now. Transacting on an account in remotest parts of the country is again not a problem now. I think what we need to move up in the chain is the fact that people can open an account, they can do payment services. UPI has become available to everybody, nearly 15%, and you will be quite surprised that nearly 15% of our transactions are now happening on UPI, and we are largely rural-focused bank or a middle income, a lower middle income focused bank. So with that category of customers, also 15% have now moved to digital ecosystem. So people are watching, people are understanding, a lot of communication is happening from multiple sources. I think what we need to now look at is how do we move up? As we see in any business, it's all about ABC. ABC means acquire a customer, build balances, and then do cross-sell. Financial inclusion to me is still in the first stage of acquiring right now. Unfortunately, we have not seen a big build-up of liability in that business. Cross-sell is still some distance away. So for me, financial inclusion has achieved the first step of acquiring and servicing. I think now we need to build that trust with the customer that they can build businesses. Obviously, we can continue to argue that they are people with limited means, so they will not be able to save that kind of money. But we now have to build that kind of trust with them so they start saving small and then go to cross-sell. And I think we have a question around cross-sell and credit and investments. Probably I'll keep it for that. But financial inclusion has come a long way, still a long way to go. But we are in a fortunate world right now with technology being available at a very cheap price, that we are able to make this financial inclusion move from a social initiative to a business initiative. Thank you.
Okay, thanks. I think, Rishi, you picked up the important issue of trust, and that's critical. But I think, as you said, we have moved a long way in the sense that if you look at the way these accounts, what are called Jandan accounts, are behaving, earlier, the day it was credited, the amount used to be withdrawn. So the banks particularly hardly had any balances in this Jandan. But I think that picture is changing quite a bit as we speak. Navin, your initial thoughts. In fact, I just want to provoke you a bit. I think during our conversation, you had even disputed the fact that India has done reasonably well in payments. So maybe you can start with that.
So my point was on financial inclusion part. So I don't want to take our credit for what we've built in the whole world around UPI, IMPS, and a lot of other payment solutions. We definitely are the leaders. But having said that, the reality remains, and again, all of us are exposed to this term financial inclusion somewhere around 2004-05, and we've been looking at it. Of course, we've made considerable progress, but the reality is largely around two buckets. In fact, one bigger bucket, which is banking, which again proves that the approach is not necessarily changed yet. I mean, while we like to say it changes, but I keep seeing flip-flop continuously every 3-4 years. So that's something which I wanted to call out. Payments, I definitely see a lot more use cases and a lot more uses by people sitting in this room. And again, to remind, financial inclusion in India is not a 20% bottom of pyramid issue. It's an 80% issue. Let me keep again and again saying, even digital payments penetration is about close to 20-25% max of the spend. Still, majority spend, while the digital is growing, let's not forget physical cash transactions are equally growing at the same pace, which clearly says that there's still a lot more needs to be done. And even some of the initiative that IMPS and UPI have put together taken, I think we all need to work harder on, let's say, something like 123 Pay, which are offline solutions. So these are the reasons I disputed. I just wanted to quickly flag two parts around financial inclusion. One, on the approach, same way. I remember 2016, our association, which was represented by me in our Ratan Vatal committee, first time we put together a plan saying that we have to change our approach of putting cart before the horse, which is putting banks for the financial inclusion, because that's misfit. Look at this 80% consumers, what do they need first? The banks become relevant if you have a savings. They actually receive money and spend. So your payment is the first need, followed by emergency credit. If he's poor, he needs a credit. And followed by the health insurance, because if they get sick, then their whole poverty cycle comes in. And if we do not identify players who are engaged in those services at the grassroots level and empower them to do cross-sell of other services, we'll not have a model. And it was accepted, it was put in on a paper, it worked for some time. We see some bit of a work happening, but I keep seeing again newer thought process from a lot of policy makers saying bank will remain central, and we have nothing against them. The problem is that the model and the economics and the sustainability doesn't work. We have to work together. So just quick flag on that, that approach still needs to be fixed. It keeps going back and forth. Second part is around three broad buckets in a financial services component, if you have to deliver. One is a product part, around the fitment to this 80%, and again within that subsegments of it. Second part is distribution, where Rishi talked about cross-sell. And if you go beyond banking and payments, anyway the rest of the penetration is in a single digit. So for an example, I still wonder, and I've asked a lot of questions even in some other forum, including once a member of IRDA chairman. If I'm a life insurance, why can't I sell general insurance? If I'm a general insurance, why can't I sell, let's say, life insurance? I just don't get it. And if banks can sell it, I mean, these are very basic questions because there are huge challenges around sustainability when you're dealing with that extra bit of a segment, because the unit economics simply does not work if you have to deliver to that customer segment. So distribution still is broken for a variety of reasons. We still see a lot of friction. Lastly, compliance. And there's one common point as a concluding point for the initial remark comes in my mind. I remember Milton Friedman advising government that you can't control whether somebody was born in a rich family or a poor family. But what you can do is probably create equal choices for them. That's in your hand. But it seems we have taken it literally. We actually want to deliver same product as is, same process as is, whether it's a compliance or let's say product or distribution model across the segment. I think what he meant is create right choices, not exactly same choices. So I want to kind of conclude there in an initial remark, and we'll probably can get into deeper into this.
Thank you. Very interesting. I think, even when I was in the Reserve Bank of India, one of the issues on which I think I did not agree with the view within the Reserve Bank is as to whether at the customer touch points, a person can deal on behalf of only one entity or several entities. Now, this is an ongoing issue. And the worry within Reserve Bank of India is that they will play one institution against the other institution based on the commission that is given. What is Reserve Bank's problem with that? The boards or the banks or the boards of the entities must worry if somebody whom I have appointed as my agent is working for somebody else. But anyway, this is an ongoing issue, but I take on from the point that you made about the banks, non-banks, and non-banks including fintechs. So whenever we talk about banks, and particularly when I'm talking to the non-banks, fintechs, they always remind me of the Diwar dialogue. So the Diwar dialogue, very popular. It goes like this. मेरे पास वो है. So instead of मेरे पास technology है, मेरे पास people है, मेरे पास agility है, तुम्हारे पास क्या है? So the bank says, मेरे पास regulators है. Okay? Now, this is the common perception that goes around. So I start off probably with Suresh and Rishi. You can take this. I think in terms of, getting the proper model right. Is there a need for consistency in regulation, the regulatory approach? Because the flip point, for instance, the digital lending guidelines came and completely disrupted everything. The data protection, about which we'll talk later, who can have data access to data came, it completely disrupted. Who can access Aadhaar, a new rule came, it completely disrupted. So the point that Navin has been talking about, there has been a lot of flip-flops as a result of which the model, before it gets tested and it gets scaled up, it gets completely disrupted. So do you think that probably we need to have a different kind of an approach, because financial inclusion today will have to be now driven forward and scaled up, in my view, and please contest it if I'm not getting it right, through innovation technology. But are we providing the right kind of regulatory environment as far as this particular aspect is concerned? That would be the first point. Maybe Rishi can start.
So this has been a constant debate, especially in the last year or so. In fact, the growth of fintechs and non-banks have been quite phenomenal. And recently also we saw some debate around the fact that the banks have not played their part on the UPI, and the fintechs have actually played a lot of innovation has come out from fintech.
But why do you worry about that? Nobody will like to play a part on UPI when you get zero revenue.
So that is where the banks came up and said that there is no revenue model on UPI, and you would probably burn billions of dollars to make it possible. Maybe the fintechs are there with the kind of money they are getting from private equity, that they are able to burn that kind of money. I think balance sheets of banks don't support that kind of money which is there. So to my mind, in fact, a lot of debate has been happening around how do we make it possible. So there is a need that non-banks have to play a role in not only delivering financial inclusion, but a lot of banking products for the masses and for everyone in general. The point which is there, sometimes the fintechs are not able to clearly make out where the innovation should stop and where the regulation should start. I think to that extent, there has to be a constant dialogue, to my mind, between the regulators and the fintechs. And with the fintech department coming up in RBI, I am expecting that department probably will take up the mantle and make it possible that a better communication can happen between the fintechs and the Reserve Bank. So nobody wants non-compliant fintechs. Maybe the fintechs in their innovation and the zeal to do much more sometimes cross their boundary and move into a non-compliant kind of a zone or into a banking kind of a zone, and the banks come up hard on them saying the fact that we are regulated, we are compliant, we have to do audit, risk and everything, whereas you don't have to do anything, and that's where the entire dialogue becomes a little messy. So a light touch kind of a regulation, something which I would say like a BC model, sir, something which came out in 2006. A light touch regulation was put up for BCs. Guidelines were guidelines came out, and within the guidelines, we all of us worked. So if there are areas where fintechs have to grow and there are areas which are identified, RBI, before it becomes up to a stage where you have to bring it back, like we saw in digital lending, a light touch regulation can come up that these are some of the areas which are allowed, some of the areas which are not allowed. Leaving it to the banks to regulate the fintechs may not be the right approach, because I don't know how much banks will be able to regulate or control the operations of the partners they are working with. But a light touch regulation from the beginning can actually make it possible. In fact, like a payments bank also, while we are fully regulated, but the guidelines had come. So we knew our boundary conditions, that these are boundary conditions. So if fintechs are also in advance, or some guidelines are there, where they can know in advance that these are the broad guidelines they have to follow, I think nobody would love to cross that line. Unfortunately, a lot of things are in gray, and that is where some of them actually cross the line. So to that
In fact,
extent, we need
I
to
pick
build
up on that last point. Lots of things are grey, so which means that it is not that they are deliberately violating, but certain things are not very clear, which goes back to the issue which I have been talking in several forums. Is it necessary for the regulations in this regard to become principle based rather than getting into micro levels? Maybe Suresh, I think while you answer, you can cover this, your views.
Sure, sir. So I basically, if I look at it, I see technology can play a huge enabling role, and we've been for long talking about risk-adjusted compliance. And one of the things which we found at the last mile, why did Aadhaar succeed? It was simply the process which was so simple that you just put your thumb and you are able to enable or do a transaction, instead of using pins and passwords, and that was really a big change. And even when I look at some of the assisted models which enabled the Jan Dhan moment, what became very significant was that how did technology make the process simple, while we still kept the underlying requirement of KYC in mind, but the cost of KYC, the way it was done, the ability to train the person to actually do the inclusion at the last mile. So technology played a huge role over there. So I was coming to my earlier point to say that whether it is product design or whether it is how you actually solve for the person on the fringe, it becomes very important how technology can be used as an enabler. And I think regulation should then look at risk-adjusted compliance, so that whatever is out there, adoption and design should align. Because otherwise, you make it so difficult for the user to actually adopt and move forward from there. And the second part, which becomes equally important, is the fact that as you are deploying this at the last mile, while tech can be an enabler, but at the same time, awareness of the consumer becomes very critical, because ultimately, regulation can't solve for literacy of the consumer. While we are definitely trying to protect the person, but ultimately, as you make them more aware, as you make them more knowledgeable, that also solves a big problem. And I was actually, we've all seen it. It's now a de facto in India. I had a few friends who had come from overseas, and they were surprised with the way a QR code is nowadays used to make payments to a merchant. And we had gone to a roadside shop, and when the payment happened, and there was a loud noise saying, "You have paid 5 rupees 20 paisa," it was a revelation to some of these people that how quickly we have solved using voice to enable the person who's selling the goods to just make sure that the money has reached their account. So some of these things have helped and played a big role in adoption happening at the last mile.
No, actually, you make an important point, but I again go back to the point that Navin was saying that probably we have achieved a lot, but looking at the scale that or the size of the country, we need to achieve a lot. You talked about QR. Let me tell you that 2 years I had not traveled out, then I went to Singapore, and I was completely fascinated by the way in which they use QR in Singapore. It's a small city state, no wonder, no comparison, but even for ordering food sitting in your room to the restaurant, you have a QR facility. So I think in terms of what can be scaled up, we have a huge probably miles to travel. You want to add anything, or shall I go to the next issue?
I actually wanted to add a couple of. So in fact, even sir, scanning of passport and immigration is done, and it's not that we don't know all of that. So challenge that I wanted to further emphasize is sir, that this whole approach of flip-flop. There is a new technology which enables certain entities who ultimately work with regulated entities, and I don't want to. This is a contest between bank, non-bank. They are good, bad, ugly in all the communities, right? It's about they coming together. Something technology has enabled, it's scaled up. Certain entities think that, hey, it's something that we could also do, replicate, but how do we remove their arbitrage? Like you said, how do you get, and I would use this sharp term that how do we get that killed and capture that market now? And I can quote two very clear examples, which is what really makes us disappointed. One is, in PPI, one time, money remittance was the biggest use case, more than Paytm, by the way. A lot of people don't know. 80% of the volume was a migrant laborer loading the money and then transferring into the bank account. 4 or 5 years back, regulation came, you can't do it without KYC on the both sides. Bank anyway is a KYC, PPIs are not. But for the same thing is allowed on a BC, which was always there. That if you go and say that this is a deposit into the bank account, it is allowed. Now the whole business overnight shifts to the other side. So what happens to the entities who started this? Nobody was using IMPS once. Today UPI is being driven through TSPs, working with banks, and everybody is taking advantage whether money being made or not. Tomorrow if a similar regulation comes and take them out completely, what happens to them? So all said and done, somebody has invested money in your objective. Another example. There is a policy which says credit card can be issued, and it's 2004 by all NBFCs subject to RBI approval. Till date, other than 2 bank-promoted NBFCs, none of them have got. You get some funny excuses, and I'm using word deliberately funny, that the complaints come more from the credit card segment, very sensitive. So it reminds me that if baby is crying, should we throw him out or just kill them so that they don't cry? Or rather solve that if they're hungry every day, let's feed them. Let's fix the problem. So somewhere when there is a demand, let's not forget, this whole digital growth in the lending has happened during COVID because of the fintechs and banks collaboration. If there are issues that have happened, the accountability should be on the all ecosystems, policymakers, regulated entities and non. Why is it that certain segment of entities always singled out and are blocked not to do it and stopped? And then the whole business model comes down. So I just wanted to flag this approach point again.
No, fair point. I think what we are asking for is there must be much more clarity as far as the regulators are concerned. It cannot be a flip-flop, and it cannot be a stoppage of business based on an interpretation which nobody took except the regulator.
And not a guinea pig approach that somebody let them go out, do it.
Right.
And like you said, I have regulator.
Okay. Now, we have 2 more important questions to discuss before we throw open. So the first question I want to ask, again to Rishi and Suresh. I think the question, straight question is, we are talking about financial inclusion. The doubt that I have is, do we have adequate quality data about the poor? Number one. And the related question is, as far as the data governance is concerned, to what extent data can be shared within and the data can be shared across? I think there has been huge amount of recent developments, mostly negative, and how this is going to have impact as far as the financial inclusion is concerned.
So as far as poor is concerned, I don't think so there is enough data which is there. Because largely the transactions, platforms or the way poor has been dealing is more on cash. So cash doesn't have any trail, so there is hardly any data which is available. So what I understand and believe, more my belief, is the fact that 5 years, maybe 10 years from now, as the poor starts opening account and becomes more digital and starts saving some money, and through some other sources, if he can get some more data, he can get some credit. So over a period of time, some data can be built up. But as of now, they may not be new to bank. Largely, most of them have accounts. 40 crore Jan Dhan accounts got created. But it's more money coming in from various government benefits, and getting withdrawn. I don't think so that's the kind of quality data one would look at. One would look at the kind of transactions you're doing, whether he's going to a chemist shop, whether he's getting a fuel done, whether he's buying something online. So that kind of data is missing. Some people in the rural space, in the lower income categories, have started to use debit cards now, and also started to do POS transactions and do online e-commerce transactions. I think it will take some time, sir. My view is it's going to take some time.
No, I agree with Rishi, sir. Basically, I think definitely it's a journey. Today, we do not have sufficient data, but some of the building blocks that we see out there are definitely making it happen. I was actually very pleasantly surprised talking to a huge network company that in rural India today, they have people on the ground who they actually say are making 10 to 15,000 rupees a month on enabling these transactions. I cut back to 5 years ago when we were working on the India Post Payment Bank model, and we were trying to see is it remunerative for the Dakya to actually provide banking services at the last mile. And it was always a challenge to even stack up 4 to 5,000 rupees as incremental income trying to provide banking services. So there is adoption. There is now more transactions. APS has played a huge role at the last mile. Even when we talk about welfare and subsidy distribution and the ability of the person to withdraw money. And I think some of the initiatives like, for example, open networks for digital commerce, where we are trying to build now a democratic e-commerce model. And the focus is again to say, let's go to the last Kirana store in the queue and give them democratic access to various fintech-related e-commerce models. I think this is what will create the money transfer, economic activity through digital modes. This is what will definitely create more data for the poor, but today it's a journey for us.
Yeah, but it also, I think we will have to flag the issue of replicating the data again and again becomes a problem. We would, all of us would agree, though we don't have a solution unless the government and the regulator agrees, is the most replicated part of the financial system is the KYC. I'll have to do my KYC, whatever I do 10 times I'll have to do the KYC. That's the worst part. Of course, this is a story which I have shared with many. The happiest day in my life came when an ex-deputy governor of Reserve Bank of India got his mobile phone disconnected because he could not give KYC after the retirement. So, and he was the signatory to the KYC circular. But anyway, and maybe I also think that the blockchain is being wrongly used. KYC data or a central repository is one thing. So this data sharing becomes quite critical as far as this is concerned. Otherwise, this becomes a problem. Now, let me get to the latest baby on the.
So one point on.
Yeah.
One quick point on data, that while we're talking data as a transaction data and KYC, we forget that we don't even know unique users of each of these services.
Correct.
So how do you even measure it? We don't know how many unique users exist for payments or for bank. It's all aggregate data. And what doesn't get measured can't get managed.
Yeah, but there is a problem. See, there are two things. One is about, I didn't want to get into this, but the data privacy, because in this country, data privacy, this has been in the making for such a long time. I can tell you that if I buy a medicine online today, all the other online medical people start sending me messages. So that is how the data is saved in this country. There's a problem as far as the data is concerned. Now, the second aspect is what Anant shared in the morning. I think you people were not there. I think the regulators are becoming extremely worried. I think, Suresh, in our conversation, you mentioned about the cyber issues and the security of this information. And that goes back to the point about the customer education. He has to be aware of, because unless the entire system is aware, I think the regulators or the government cannot ensure every time the data. Let me come to the latest, CBDC. Lot of things have been talked about. One of the use cases for CBDC has been talked about, touted as financial inclusion. Now, the other side, people are asking the questions, what is the difference between an UPI and CBDC? Why do we want retail CBDC in this country? Will it achieve anything which the UPI has not achieved? So much so that impromptu, the RBI governor during the monetary policy had come out with what is the difference between UPI and CBDC. I think a person probably who has participated in every CBDC seminar in this country, Navin, Surya, I would ask him to answer these questions. First of all, what is CBDC? How is this different? And do you think that that is going to be a game changer as far as the financial inclusion is concerned?
So I think basics, we mostly know two types of CBDC. Both are issued by central bank, just like the physical currency, wholesale and retail. But for this purpose, to keep short, I'll focus on retail one. Retail is, I say in very simple word that it's a physical currency on steroid. Why do I say so? Because your currently physical currency cannot be used in digital. You cannot put your bank note into an internet and a phone and make it use. So the moment you digitize and in digital form you receive it, it immediately is fungible across all possible channels. And it has exactly same characteristics. In a way, the way you go out to a kirana shop, buy something, give money, transaction is over. Payment and settlement both happen simultaneously. Finality is right there. In everything else that happens today in payment space is in a bank money, which has payments and then settlement. Even in a product like UPI, when two transfer happens between two parties, while you and I receive and transfer money, debit credit happens immediately. Behind there is a settlement process between the bank. For CBDC, it's not required. Now, inclusion perspective, trying to keep it short, and we can take more questions later on this if required. The ideal use case, and don't go by the pilot the way it is being run. It is primarily a test of use case, some of the features, and eventually things won't be the way they are. Currently, it looks a lot more like a UPI, but it's not UPI. UPI is only a tool to move money. Currently, your bank money, eventually e-currency. So that's an application to move money. This is actual currency. So the simple use case from an inclusion perspective, best, let's say if I'm a government, I want to give money for a benefit to the user. Simplest way could be that if they have identified those users, as long as they have a basic digital device, maybe even a feature phone, theoretically the technology exists for you to get it. You receive a code directly based on your identification, that's your money in your hand. And because it is equal to currency, you could start spending it in your local ecosystem as long as there is a basic digital device with any person. And then if you want, it's a reverse process. You could probably transfer into a bank money and convert into a bank money if you want, if you have still some money left. So the process completely changes. A lot of other friction that exists today completely goes away. And it actually becomes immediately 100% fight against the real physical currency.
Okay, anything one of you want to add? That's fine. So let me go to the last part of my question, and then probably we'll take a couple of questions, time permitting. One is that we want to make 2 or 3 recommendations to the authorities or regulators as to what is the best way forward as far as scaling up financial inclusion further in this country is concerned. And what would be your thoughts? Maybe Navin can go first.
Sure. So I think, sir, this fixed approach, I think collaboration model has worked. It's proven already, whether it's UPI, IMPS, even credit to some extent. Now, I think somewhere the policymaker has to think that which are the issues being raised, are they genuine in name of customer protection, in name of sometimes, I mean, I really keep hearing the systemic implications. Sometimes I worry, how does a retail credit really even go there? It doesn't actually, we all know that. But I find it very funny. So again, a fixed approach, clearly looking at the risk and fixing, like Suresh said, risk-adjusted approach continuously. And somewhere we have to understand that if inclusion has to work, the distribution part and the compliance part has to be drastically changed. It will not work. Cross-sell has to be allowed to everybody who's included in an inclusion framework, without which the model does not work. Compliances cannot be same what is actually for a very high value transaction. It has to be drastically shifted. And we all understand it's allowed in FATF guidelines, which is what we keep being thrown at.
So, sir, I think Navin has already said that, but I think from a regulatory point of view, a more open regulation will definitely help. I'll give you our own example. Payments Bank, a lot of distribution has been set up. Nearly 2.5, 3 million points are there all across the country. We are enabled to do payments, we are enabled to do liabilities, but we can't offer credit. So, being one of the largest distribution points across the country, dealing with the real financial inclusion customers, the need of the customer, when they come, they open an account, then they ask us, can you offer credit? So we say we can't offer you credit. So something like this, a more open regulation would definitely help the ecosystem which has been created, the infrastructure which we have. Why do we need to restrict it by regulation? We should be more open to such kind of changes in the regulation. I think that can help financial inclusion in a big way. And coming back to my same point, if there has to be some regulation at some point, it is better to be upfront and bring up that light touch regulation, and it can be entity to entity based. Some of them are really small, maybe given more arm to be innovative. Somebody who's really big, like the big tech, whether they should be regulated, not regulated at all. So a lot of questions around that has been there, but a light to a high touch regulation can depend on entity to entity as well.
So, sir, I think basically with, as we were talking about, data is going to become and is always very important. And as we get into the digital data realm, the account aggregator ecosystem, and how do we actually look at consent, provide assisted consent sort of architecture to the people so that everybody at the last mile can use it. Because it looks like we have to create some assisted modes over here, just like UPI adoption needed time and people needed to be educated how to even get a UPI handle.
Sorry to interrupt your thought, but there the problem comes in. You mentioned about the account aggregator. Today, an account aggregator which the Reserve Bank of India has permitted, he cannot straddle the capital markets from the same entity. He will have to have a separate entity because otherwise two different regulators come in. So the issues of cross-selling, being able to cross-sell, and the regulators coming together. Yeah, probably there is an FSDC which you can call it as a regulatory aggregator, but really they are not able to work beyond a point. So ultimately these regulators will have to come together to make sure that this cross-sell and the innovation which can be seamlessly applied across happens. But sorry to interrupt, go ahead.
No, I agree with you, sir. Basically, going down the same path, the whole point is it's data, it's personal information. So the information can be financial, it can be health. You gave the example of, you picking up some medical stuff and it gets published all over. So as we are looking at technology as an intervention point to create open stacks in health, in agri, in financial services, data stack is the first one. So how data is monitored, measured, how do inter-regulatory and inter-sector work happens together in this space aligned with the data bill is going to be very critical.
Let me take a quick vote before I throw open if there are any questions. Do you think that the way forward as far as the data is concerned, it must be a pure consent architecture rather than the regulators coming and deciding what can be shared and not shared? You think that's the right way? Yes or no? Yes. It's all yes, is it?
Yes.
It's all yes. Okay. I think these are the issues which I basically wanted to discuss with my panelists. You would have seen the depth of their experience and knowledge. We are open to take a couple of questions. Bijur? Yes. Okay. No, that depends on the questions. Otherwise, I'll...
Navin, as you mentioned, this is something that we hear from other fintech companies also. What is it that CBDC is adding to the existing payment system? If we have UPI, why CBDC? But we can flip the question. If we have CBDC, why UPI?
Actually, it's a wrong question. Then they are apples and oranges. Like I again repeated that if I have to go from a destination A to B, what UPI is a transport mode, not that destination. Currency is the destination. And again, think of CBDC as nothing but your currency in digital form. Like I said that the moment you give your cash transaction is over. In UPI for you it's over, but it's actually not. There's still certain challenges. So think in that sense, what it does to the ecosystem is completely different. There are a lot of models which will get disrupted, right? There are a lot of things that can be done. Imagine that if I'm a vegetable vendor, today if I have to participate in a formal payment systems other than UPI everywhere else, again there is a T plus something. It could be a time or a day. But if I have a currency in my hand and if I have a basic feature phone, I receive the money, I go back and give it that. I don't really necessarily need the loans for every day because my money is already with me. I can start using it. So the implications are completely different. I don't think most of the people in the ecosystem other than the limited parties who participated in the pilot have even thought through the implications. So to go back and think, forget what exists. Think if the money is digital, what is money as a currency in your hand? Not money but currency. what can happen? Forget what the current infra is, what it should be.
No, I think maybe let me try and give you a more honest answer. Okay. I think the central banks around the world started worrying about crypto. So they wanted to have, because crypto had its own problems. Whether we like it or not, no regulator will be happy with crypto because that's a pure speculative asset, no underlying, and if there is a problem, the kind of problems that has happened, and the regulators get blamed for. Even in this country, I feel that we have done a great disservice to the entire community by not coming out with a firm view one way or the other whether crypto we want or not want. Having said that, so people wanted to come out with this. Now, you will have to think of CBDC as an alternative to cash, not to a digital transaction. So then the question arises, is it going to be adopted? If it is adopted, what is going to be the advantage? The advantage is that my cash distribution cost to the country, which has a certain amount and which has an implication for GDP, etc., or expenditure, central bank expenditures, etc., that could get controlled. Now, reaching these people, it will be easier rather than reaching cash, given the length and breadth of the country. But personally, I think the biggest use case of CBDC retail is going to come about in the P2P cross-border transactions, right? Now, you cannot start off with a cross-border transaction, so the way in which we are getting people used to this local transaction, it's a fair experiment. But whether it is going to make a material difference as far as the people's usage of currency or currency habits, and people are going to move on to CBDC instead of keeping cash, I have a doubt. Now, the other question that at least I must be honest enough to answer is that the so-called anonymity that is being talked about is complete nonsense. I don't think anything which is linked to technology can say that I am anonymous. I mean, the simple example I can draw is that when I was heading the Hyderabad office, we have every regional director has a monitor which particularly monitors what is happening in the cash department in the Reserve Bank of India. Those days, one of our deputy governors, he is no more now, Dr. Tarapur, he came there and it was supposed to be an incognito visit. But I could see it. So I sent somebody to ask him whether he can come for lunch. Then his doubt was whether his visit was made known to me. How did he know that I am here? He said he saw it on the TV. So the anonymity of CBDC is something similar to that.
That was a big one. Good one.
Regarding the same CBDC, I have one observation. Please correct me if I am wrong. So there are two perspectives. One is from the user's perspective, other is from the regulator's perspective, RBI's perspective. What I feel is there are some demerits of the cash which CBDC will take away. So one is tracking. So now if I have to say, I withdraw 10 lakh rupees in cash and give it to somebody else, there is no tracking. I withdrew and gave it to somebody, the connection cannot be made. While when it is in CBDC, it can be made. So one is tracking. Second is...
That's answered. That's why I said no anonymity.
Second, of course, transportability we are talking about and lesser cost for the central bank. So if we move gradually away from the cash system to CBDC system, I think some sort of, corruption, control and all will also happen.
Yeah, but let me add one fundamental point. It's about velocity of money. When it's digital, it will move fast, which means everything will grow fast. That has huge far-reaching implications.
Yeah, but the corruption in this country being completely removed, I think we'll have to remove the word jugaad from the dictionary.
It can happen in cash.
It makes jugaad a bit difficult, sir, in this case. That's
Corruption can happen in cash anyway.
Thanks, sir.
So
I have one question. How CBDC can improve the efficiency of cross-border wholesale payments involving multiple currencies? I am hoping that this will reduce the transaction costs and makes international business quicker.
Yeah, I think even Malingam will be able to answer that. I think today the central banks are worried about the cross-border transactions for 2-3 reasons. One is the speed of settlement. The second is the cost. And the third is the transparency of the rates applied. All these things they think can be taken care of if the central bank gets into the picture and the cross-border can be taken. That's fairly simple. But I hope all this will happen because it depends upon the other countries coming. And this country has additional implication in terms of the exchange control still remaining. And that will have to be, now every P2P transaction, if the enforcement directorate comes into the picture, then people will stop that also. So we'll have to think about that. I've given back your 10 minutes. Okay.
Thank you so much, gentlemen, for a lovely discussion right here. I'd like to invite on stage Mr. Ramakrishnan S. to please come up on stage and give the mementos to the lovely gentleman right here. Thank you, sir. Huge round of applause, ladies and gentlemen.